And now for something completely different.
Forget everything you've been told by others before.
There is a niche. Niche? Niche? It's a niche.
I don't know.
It's a niche. The niche. It's a special area. There we go.
Get ready for the real deal.
Most important question, Lance.
Yes.
Pineapples on pizza or no?
The full story.
Me personally, if I'm going to eat a pizza, it's going to be a pizza.
I'm not going to order pineapples on the pizza, but I'm also not going to chastise somebody for doing it because I really don't care. Do what you want to do.
The whole enchilada.
So when you eat chili, beans or no beans?
No beans.
It's money, news, and information you can use to grow financially healthy, wealthy, and wise.
Your Excel Word example. It's a great example, right? Because there's Google Sheets, which does Word. Loaded. Okay, Boomer.
Now, welcome in The Real Deal, the real investment show with Lance Roberts. Presented by RIA Advisors.
Hi, I'm Lance Roberts, and you're listening to The Real Investment Show. Of course, this is one of our interview series, and our special guest today is Brian Dunlap. He serves as the director and lead strategist for thematic and alpha ETFs. He's a senior strategist for digital assets and ETFs at Blackrock, and in that dual capacity, he really kind of partners closely with their sales team to deliver market intelligence, product expertise. And, we had Brian Dunlap come down for our conference back in January, and I was so impressed by his knowledge and breadth of the artificial intelligence space and the crypto space as well, that I wanted to have him here for all of our listeners to listen to what he has to say and kind of get an update on where we are with AI. And so, Brian, welcome to the interview today. I appreciate you very much for taking the time out.
Yeah, thanks. Thanks for having me, and appreciate the invite back after your economic summit back in January. So that's always a great testament to the partnership that we have, and hopefully we can deliver here again.
Yeah, absolutely. I'm not worried about that at all. Well, here's the thing, Brian. So when we were kind of having that conference back in January, tech stocks, in particular, the Mag 7, the AI story, it was still very much intact. There was a little bit of weakness, but nothing overly dramatic. But since then, we've seen a lot more weakness in companies like Microsoft and Oracle, Meta, some of these AI names. There's been some concerns about the kind of where AI is going. Of course, we're spending, this massive amount of money on capex for building out data centers. And there's now been some questions about future revenue growth, what's going to come out of AI. And then, of course, this whole kind of private credit issue that's popped up as of late with, software as a service industry. AI is going to destroy that industry, and all the debt that, AI has been taking on is now at risk. And, these narratives get a lot of headlines, Brian, and scares a lot of investors. And what I want to spend a little bit of time today is kind of revisiting the AI story from the beginning. Has that story changed as to where we're headed in terms of AI? And then discuss some of these risks that are currently circulating around. Are these real risks that we need to be, overly concerned about, or are these risks that are going to pass in time, and the true narrative of AI and artificial intelligence as a tool, as a profit center, et cetera, will that reemerge? So that's kind of the baseline for today's conversation. But I wanted to just kind of start.
That's it, Lance. Just that.
Just that.
That's just a little bit to unpack.
Yeah, just a little bit. And so let's start with let's start back at the beginning just for a second and talk a little bit about the AI story. Why is AI such an important thing for the U.S. Not just for the U.S. economy, but making sure that AI wins that AI race relative to the rest of the world?
Yeah. So all of this stuff, I think, is going to be a great conversation between you and I, Lance. And it's funny when we talk about kind of where we are today. I think it's really important first to almost take a step back, if we could, and just talk about the context of how we got here. And I do that because, I've been at a lot of events like your economic summit, although the one you put on was really, really well produced, I think top notch. But I've spoken to clients all over the country, and particularly some of the older clients that have some of this consternation around artificial intelligence. They feel a little bit more at ease when they think about this in the context of, call it the last few decades, because we've gone through a remarkable amount of technological change that today feels ubiquitous, right? Like it feels just like part of our business as usual, but at the time was actually pretty remarkable. When you think about things like the internet, when that came out, there was a lot of concern around how that might reshape society, how that might reshape the workplace. But today the internet is basically a part of our everyday life. Like I kind of think back to the internet from an elder millennial perspective. when my brother and I remember the Christmas morning, we got our very first family PC, and it like strikes me, when we logged on, we died of dysentery on the Oregon Trail. But it strikes me when you log on to the computer, my kids don't know the joy of that sound. The modem dial up, because even when they were born, I have a 10 and 12-year-old daughters. We were talking about that earlier, Lance. When they were born, every device they touched was already connected to the internet.
Right. And
that's not true. That wasn't true 30 years ago. If you think about smartphones, I still remember my dad getting the car phone, that big honking thing that took up the whole front seat. And then you get, the smartphone. And if people are like me today, you have two, right? You got the personal, business, and pleasure. But I remember having to, I grew up outside of Philadelphia, and I went to school at Penn State. You could probably see my Penn State gear over here. 200 miles west, I had to get a new phone and a new phone plan, Lance, when I went off to college, because it was long distance to call home to let my parents know I was okay. Meanwhile, today, my kids use that thing on their wrist, that Apple Watch, to call my brother in California. They use my phone and WhatsApp to call our family in Spain. And you think about the ability to look up anything, anytime, anywhere, how disruptive that felt 15 years ago, but how kind of commonplace and central to our daily habits it is today. And I think AI is just kind of the next part of that evolution of technology. So again, I've shared that with a lot of clients, and they say, hey, thanks for reminding me of everything we've already been through. It helps put me at ease a little bit as I think about where we are from an AI perspective today. And when you think about it, ChatGPT really just hit the world a little over 3 years ago, November of 2022. That's when like AI became a commonplace term. Before that, you needed to know computer code to really engage with AI. I'm not a coding guy. Are you a coding guy, Lance?
Not at all.
Yeah,
well, I can code now with AI. I just ask AI to code for me.
Right. So the crazy thing is, right, like to drive that car, to be a driver, a licensed driver of AI 3 years ago, you needed to know code. Today, all you need to know is a modern, a major language, English, Mandarin, et cetera. So we have billions of licensed drivers. And to your point, maybe 2 years ago, there was 200,000 coders in the world. Or 200 million. Yeah, sorry, million.
Yep.
Today, there's like 8 billion.
Yeah.
Right? Because anybody can code. So, what's going to end up happening is artificial intelligence will likely be a foundational piece of all of the underlying technology that we use, kind of both hardware and software. And I think you kind of mentioned it's critical for the U.S. to be a leader in this space because as we do enter into periods of higher geopolitical tension, and geopolitics is one of the other major themes that my team sort of tracks. AI will become a piece of national security, whether it's data protection, whether it's protecting against cybersecurity, whether it's creating economic moats around our country and our key companies. So AI has become a really, really critical technology from an economic, from a societal, and even from a national security perspective. Yeah. So that's kind of how we're thinking about it a little bit, Lance.
Yeah. Let me pause you right there because look, what you said was really important because like my first computer was a Commodore 64 because I'm a lot older than you. But yeah, when you go back, and you think about the internet and this is what's interesting about AI, there's a lot of conversation right now is like AI is going to displace all the jobs. There's going to be, nobody's going to have to work anymore, et cetera. But we lived through this with the internet. My father worked for a manufacturing company, Dow Chemical, and he was like, man, these computers are going to, they're just going to, take everybody's job. And they did. There were people that lost their jobs because of computers. And then when the internet came along, he was like, this is going to take everybody's job because of the internet. And we did lose jobs, right? I mean, we used to have receptionists. We don't have receptionists anymore. And AI is going to certainly displace work, but I think it's important to focus on the fact that, you go back in history, we've had multiples of these industrial revolutions. The auto manufacturing replaced horses and buggy whip companies. and so, and the world didn't end and the economy didn't die. But we created all new industries that we weren't even thinking about then. And this is the important thing I think that we need to focus on is AI is certainly going to displace jobs. There are going to be people that lose their job because of AI, and we're going to have reduced labor forces in a lot of areas because of AI. But new jobs are going to come out of this, because somebody is going to figure out a way to use AI in a way that we haven't thought about yet that's going to create a whole new industry. And, so when I think about, the AI industry and what's happening, I'm really excited about it because I think there's so much opportunity, but there's so many concerns about the death of the world and the death of the economy from AI that I think that people just have a short-sighted memory of all the advances we've made since 2000, and we're still here.
Yeah, we're still here. We're still thriving for the most part. And what I think you just said too, I think is important to take a moment and pause on, because there's a lot of rhetoric out there around sort of, like you said, the death of jobs or what have you. But I mean, you go back to like the mid 1800s, and when you look at all the different revolutions, the steam, the electric, when you think about the internet, we haven't seen a major industrial technological revolution be a net detractor of jobs historically. Right. And again, like I don't claim to have a crystal ball to know where we're going, and I would be very, very skeptical of those who claim to. But what we have seen through time is a fundamental shift in the employment landscape, the types of jobs. And you kind of reference that, right? Mm-hmm. Back in the 1850s, I think 50% of the U.S. Labor force was agricultural. Today, it's 2%. And after the revolutions, that started shrinking. After the internet, it was IT and comm services. So it's fundamentally changed. I kind of use this statistic. I forget the data source or the third-party source that had this, but I use my dad as a reference point. So he graduated from college in 1974 from LaSalle. Go Explorers if you're from the Philly area. And when he graduated, compared to someone graduating today, 50 years-ish later, there's 50% more jobs or different jobs for the graduate today than when my dad graduated college. Mm-hmm. And the point that you made about things we don't even think about, I mean, when Steve Jobs put the internet, a camera, and a phone all on one device, he didn't think about the $32 billion online influencer industry where people just build the brand online and they talk about the cool products that they have and get you to buy it, and they get paid. Like, that wasn't even a thought. So there will be a remarkable, I think, shift in jobs. But again, the hope is that if we use history to inform where we're going, that there's an opportunity here to reshape the employment landscape.
Well, so let's talk a little bit now. That's kind of a repeat of history. This is where we are today. Let's talk about where we kind of are going forward. So, again, a lot of concern here is of late about, it's always interesting to me when the market pulls back some and we have a correction. Everybody's like, oh, it's the end of AI. AI is dead now. We just had a massive run from the April lows after Liberation Day to where we are now. These stocks had huge advances. So a bit of a correction technically was warranted, but the narrative is valid, right? I mean, there's I should say the concerns are valid. Whether or not all this expenditure on AI is going to generate the revenue in the future. Maybe it will, maybe it won't. I tend to suspect it will, because of how AI is going to be used throughout industries as a whole, whether it's defense, whether it's national security, whether it's healthcare, whether it's finance, legal, whatever. There's going to be models that are set up that generate revenue from that. And there are certainly going to be some companies that fail. I was talking about this the other day. You go back to the .com era, right? In 1995, 1999, everybody was throwing out an internet business, sticking .com on the end of their name, and stock prices were going through the roof. They didn't have a business model, but they were all going through the roof. And I think that very much applies to today, is that there's going to be some companies that are out there saying, hey, yeah, we do AI. We're doing great things with AI. We're an AI company. That's awesome. But they're not really differentiated from anybody else. They don't have that moat that protects their product, and they're going to fail. And then there's going to be other companies that are going to succeed and succeed wildly, just as we saw Amazon do coming out of the .com crash. Apple, Microsoft did fantastic. And I think that's going to be very important for investors to kind of look at going forward, is trying to separate out those winners from the losers. But from your perspective, what does the future of AI look like for Blackrock and for where y'all are?
Yeah, that's a great question. I think some great framing, a lot of things I think that we can double click on. So let's take stock a little bit of where we are, and then kind of where we think we're headed from here. And we can talk about some of the revenues and the AI washing, et cetera. We can certainly dive into those things. But as we think about the adoption cycle, and it's really important because that's from my lens where I sit, right, the leading a team that thinks about these themes or these mega forces, these structural forces around the globe that are changing the way we live, the way we work, the way we spend our money, the things we think are going to drive outperformance from an investment perspective when you compare it to those traditional building blocks. When we look at these things, we have to look at them through the lens of their adoption cycle. Because we have to remember, and we live in a world of the TikTok attention span. This isn't quarters to years. This is years to decade plus. And from an AI perspective, when you think about that S curve, and by the way, when we draw the S curve, it's always a smooth line. That's the academic way. Lance, as well as anyone. Yeah. It's never a smooth line. There's leaps forward and advancements where we exceed expectations. There's fits and starts where we pull back.
It's more like a W.
Yeah. Or it's just like a zigzag. Yeah, exactly. But we think that there's a clear line of sight to where we are in the end. It's just how we get there is going to be kind of bumpy. And that's any revolution or kind of innovation that's going to be the bedrock of our society and economy. So I think that's a great framing is the adoption curve, the adoption cycle, and how long they can be. The mobile phone adoption cycle was something like 12 or 13 years. The e-commerce revolution was something like 20 years to get from like start to finish from their true adoption cycle. So we just need to keep that in mind. By the way, the smartphone space would have outperformed global stocks by 1.5 times over its adoption cycle. E-commerce outperformed the NASDAQ by 2 times, the MSCI by 4 times over its adoption cycle. And again, we think AI is one of those big themes that will drive out performance into the future too. So, but where are we, right? So I took a long time to talk about the adoption cycle, but it is important.
It is.
Where are we? We are still very squarely in the infrastructure build phase. We're in year 3 of what could be a 5 to 10 massive build out of the physical things that we need for AI. When I say the physical things, it's the land, it's the power production, power transportation, power storage. It's the data centers, it's the chips, the servers, the racks, the cooling, all the physical stuff that we need for AI to work. And we've seen massive capital expenditure. I think last year, just the big 4 hyperscalers were somewhere in the neighborhood north of 400 billion to 450. Next year, we see somewhere probably over 600, moving to a place where we get to $1 trillion spent in a year on the physical stuff. But it's critically important that these things get built out because as we're starting to move into the next phase of the AI adoption cycle, which is consumer and importantly enterprise adoption, AI demand and AI use will go up dramatically. In our 2026 thematic outlook that we put out, my team authored, there's a really, really great slide that shows token use. Tokens are simply, it's the smallest form or the smallest piece, if you will, of kind of compute that AI registers. So when you go to ChatGPT, you put in a prompt, a word like chat might be 1 token, a word like subsequent or inconsequential might be 3 or 4 tokens. If you're asking to produce an image, it might be 100,000 tokens, but it's the smallest unit of compute that AI uses. Token use over just the last 12 months has gone up 17 times. Which means people and enterprises are using artificial intelligence more and more. So the investment, we need to lay the tracks, the physical stuff today to meet the demand for artificial intelligence, not just today, but as we move into the future. And this is where the revenue story starts to play out too, Lance, because you kind of asked about revenue. First off, remember the capex I talked about, the 400 billion last year, the 600 billion this year. One company's capex is another company's revenue. So we're actually seeing revenue in a pretty meaningful way come through, particularly in the infrastructure players of the artificial intelligence tech stack, if you will. And as we move forward into this enterprise adoption, you're going to see that revenue start to flow into the model. That the companies that are building these AI models and into the companies that are going to figure out the apps, the agents, the services that are going to allow us to interface. So the opportunity set and the revenue will kind of flow through that AI tech stack, infrastructure, intelligence, and agents, if you will, as the adoption cycle continues to move forward. And then once we get past enterprise adoption, then we get into the physical AI, the robots, the drones, the autonomous vehicles, the real world AI, like really unlocking some of the power that we could get in medical innovation. So that's kind of how we see, Lance, the AI adoption cycle, infrastructure build, the consumer and enterprise adoption, and then real world AI. And again, that opportunity set kind of shifts as we move through that adoption cycle in terms of where the opportunities lie.
Right. No, and that's good. That's a great jump off point because this is thinking about that now. So if I was thinking about investing in this cycle to come. When you think about infrastructure, that's not necessarily the Microsofts, that's not the Metas in general. We're seeing that flow into companies like Caterpillar and people that are moving dirt, Schneider that does the electrical build out, Applied Dynamics, which does the cooling. So what's an easy way to take advantage of that infrastructure side for kind of investors now to be looking at?
Yeah, when you ask easy way, are you talking about what's an investment product, or are you talking? I mean, so there's a handful of ways, at least from a Blackrock perspective, if you were looking, or an iShares perspective, looking to capitalize on the infrastructure build, this massive infrastructure build we're seeing take place right now. So IDGT is one of the ETFs that we have that is specifically dedicated to digital infrastructure and real estate. And that's an index-based ETF, and that is kind of a really precise way to get exposure specifically to that space. And it's done, as you can imagine, pretty well in the environment we're in. Also, there's another ticker we have, BAI, easy to remember, Blackrock AI, but it's our actively managed artificial intelligence ETF. And that's exactly the way they look at the world, is through that tech stack, the infrastructure, the intelligence, and the apps and services and agents. And what's, I think, pretty good or pretty, I think, useful in that product is the team that manages it has been doing it here at Blackrock for over a decade, almost a decade and a half, managing the tech space. This is a newer ETF that now is focused on the AI space, but they have the ability to navigate or kind of be nimble across that tech stack as the opportunity set shifts. Right. And today, as you can imagine, they're overweight the infrastructure layer of the tech stack, taking advantage of some of the companies providing the power, some of the companies moving the dirt, some of the companies building the data centers. They're packing them full of these semiconductors, these GPUs and CPUs and TPUs, and making the connections, the cables, and all of that, the servers, the cooling. So they're overweight right now, that space particularly. But they have the ability to maneuver and be really, really nimble as the opportunity set shifts, as the adoption cycle progresses.
So yeah, let's talk a little bit about that. So let's say that I'm I kind of follow this logic, right? So in the next 3 to 5 years, I'm gonna have this big build out of data centers and storage and these type of things. Once that's built, obviously that opportunity is going to start to fade off, right? Because now it's all built. And then we're going to move into the consumer phase. So how long does BlackRock kind of expect that kind of data center structure, infrastructure build out to last? Is that 3 years? Is that 5 years? Is there kind of a window for that?
Yeah, so I think we're in year 3 of kind of, like I said, a 5 to 10 year infrastructure build, but that might shift over time. So at some point, we'll probably max out the physical, data centers that we're going to build out, but the maintenance and the evolution of the insides of those things. I don't know if you've ever been to a data center, by the way, Lance. They're remarkably unimpressive. They're literally just giant warehouses that are pretty empty, that are filled with this like racks of these servers and pipes and cooling. It's again, I expected a lot more when I went, and it's to the naked eye really unimpressive. But these semis, these chips inside, they do have a useful life, and it's now with the kind of technological evolution, some of these are 6 years plus. But so the other piece of this too is, right, and if you watched any of the or kind of read up on any of NVIDIA's GTC this week, we are starting to hit or move towards an inflection point in AI, where we move from training to inference. And really, really simply, training is the part of AI where you build the model and you feed the model just like ungodly amounts of data, and it starts to identify patterns and trends, and it learns, right? It's like when you go off to college, you're just soaking up lots of information, but you're kind of worthless to the world in terms of adding value. And then when we get to inference, that's when you deploy the model. And as we're moving towards consumer and enterprise adoption, and that token use is going up, that's when inference, we hit that inflection point. But so far, the spend has been, call it 70% or so on training versus inference. And different chips, different semis are more effective, more efficient, and used for training versus inference. But the longer term projections is that 70% plus could be on inference. Okay. And that's the ongoing spend that you'll have in continuing to maintain and modernize and innovate the physical stuff. And by the way, like there's a lot of speculation. Tony Kim, who manages our BAI active AI ETF, when we think about the infrastructure piece, he's optimistic on what we could do in terms of putting data centers in space. So we may not.
I'm not ready for that yet.
But the idea is, right, like instead of land and water and power being the bottleneck now becomes launch payload. How much can you launch into space? Because power is free because you're getting solar from the sun. Cooling's free because you're using the sub-freezing temperatures of space. Yeah. Right, and you don't need the land. So it's a whole different shift if we move, as we move 5 years down the line. But I think the crux of the question is kind of like, where does the opportunity evolve? If you think about it, it's going to be the use of some of these models as enterprises. And by the way, like enterprise adoption, McKinsey had a report last summer that said 1% of companies they surveyed were at quote unquote maturity in terms of integrating and monetizing AI. Something like 80% of companies were experimenting, integrating, and then 92% of companies said they know they're investing more over the next 3 years. Actually, I have a report here. Boston Consulting Group, I think, is the one. Yep, Boston Consulting Group has this new report. They say 5% of companies are future built. Where they are actually generating substantive value from AI. So we really haven't even scratched the surface yet of this enterprise adoption, when you're going to start to see that revenue flow back to the model innovators and developers and the companies that are going to build the way we interface. And it could be a whole different pricing model. Instead of licensing, like per seat, it could be tokens. Right, just the way you pay for electricity when it comes in the house. It's how much passes through the meter versus how many things you have plugged in.
Right. So let me lay out an investment thesis. Let me just see if this sounds right to you. So if I was thinking about this in the future of managing my portfolio in particular, I'd want to kind of overweight the construction and developments, the infrastructure side, right? So the construction, the paving, the roads, the building of bridges, those type of things, the electrical build out, all that now, 3 to 5 years. In the process, I also want to own the companies that are spending the capex doing this, right? Because these are going to be the future receivers of what's being built. Elon Musk made a great statement. He said a while back, he says, don't think about data centers as data centers. They're factories. And when you build a factory, you build revenue. And I think that's an important distinction between just building a building that houses a bunch of computers, but understanding that these are factories that are going to produce revenue in the future.
100%.
Yeah.
100%.
And so the thesis then, but see, and you made a great point about, once the data center is built, that's great, but there's going to be continuous innovations in chips and memory storage and these type of things. And those are going to have to be swapped out. So the servers that are there now, the chips that are there now, they're going to have to be swapped out and upgraded. It's kind of in that second phase as we continue to adopt and grow and expand. Companies like NVIDIA are going to be on that edge of that. And they have that continual revenue source of constantly having to swap out, upgrade chips, and keep the data centers up to speed. And then lastly, the revenue comes at the end. So it seems like the real benefit to companies like Microsoft, Meta, Amazon might be 5 to 7 years out. But there's that's where that revenue generation really kind of starts for them. Is that right or wrong?
Well. So, and again, and you mentioned some of the hyperscalers, right? Yeah. Some of the hyperscalers have different, like Amazon is part of the cloud, right? So they're benefiting from the demand in cloud. Same thing with Google, cloud, Microsoft, Azure with the cloud. But as we think about the tech stack, kind of that I mentioned before, the way I sort of think about it is the infrastructure stack grows over the next 3 to 5 years. Right. The cloud, the compute, the power, that all grows. I think the model piece of the stack that grows, right? The revenue that's going to come from the models. I think the applications and the software, right? Like that probably shrinks in terms of the revenue that comes from there. But then there's a whole new layer of the stack that comes, which is the physical AI. So I think you kind of had it right. Is over the next, call it 3 to 5 years, I think the infrastructure layer of the stack does probably pretty well. Kind of over the somewhere overlapping that, I think you have the model or the intelligence layer of the stack. And then as we continue to progress out, I think that's where that physical layer of the stack really starts to grow. And you sort of talked about building these data centers and thinking about them as factories. There's a really cool statistic I saw just recently from our fundamental equity team. When you build these data centers, the first 3 years, basically, you're kind of net negative. And then that 3 to 4 year period is when that factory starts to become net positive. You think about kind of the J curve, right? And then you're making 12%, 17%, 21% IRR in kind of years 4, 5, 6, and potentially beyond. And then you have to get into, maintaining the guts of your data centers. But these things are factories and they're producing tokens, and those tokens are going to be really, really valuable as we move forward from here. So I think kind of the way you framed it makes a bit of sense. And the factory analogy is starting to feel more and more real. That Elon, I think that, like you said, that was an Elon quote.
Well, let's just talk a little bit about some of the current kind of concerns that, are kind of surrounding the whole AI narrative. And again, every time AI stocks dip, it's the end of AI and AI is a failure. And, this was all, hokey. And I remember everybody saying the same thing about the internet, right? The internet's just a fad, right? So nobody's ever going to use the internet. Well, here we are. But we saw companies like Oracle take on a lot of debt. We've seen Meta take on some debt, do a lot of capex expenditure, Microsoft, Amazon, Google, all the same way, lots of capex, hyperscalers. This is now kind of surfaced, and some of the concerns over some of the issues with private credit. There's Blue Owl and some of the other private credit companies, suddenly having to gate investors. Of course, I think that's a totally kind of almost humorous thing, because people wanted an illiquidity premium and now they want liquidity and they're worried about having gates. So, that's a different story we'll get into later. But, are these concerns that are happening, around, say Oracle's debt, are these valid concerns? Are these things we should really look into much more cautiously? Or do you think this is something that is going to pass and will eventually move forward?
So I would be ill-advised to say that I'm an expert on the credit side of the world. Obviously, I sit more on the equity side.
Right.
But I think it's important to also just bifurcate part of this market, right? Because you kind of mentioned Oracle, and I'm not making any recommendations on Oracle.
Sure.
Or anything like that. But some of the neo clouds, these newer companies that have sprouted up that are providing cloud services to help facilitate the compute and the AI revolution. As newer companies, their credit rating tends to be a little bit lower. Versus if you look at the big four, your Meta, Google, Microsoft, Amazon, they're AAA, AA credit rated, and they actually have a negative net debt, which means their net debt compared to their EBITDA and their revenue, right? Like their EBITDA and their revenue just exceeds it massively, versus the neo clouds where they do have substantive net debt. So I think it's important to bifurcate those two and not conflate them, if you will.
Right.
So I think that's number one. Number two, when I think of funding sources, which is one of the factors that I think about as I'm continuing to monitor the AI build to really feel comfortable that we're in boom versus bubble phase, and it is the funding sources. And today, still the bulk of the funding, particularly from the hyperscalers, which makes up the lion's share, is coming from cash and free cash flow.
Right.
Our team's thesis is that they will spend basically up to their free cash flow because they view not investing enough as an existential threat to their business, their moat, their competitiveness, and their business ultimate survival, because they view AI as kind of the bedrock foundation of the future economy.
Right.
Now, if some of these really, really high quality companies do take on some level of debt, a turn or two of leverage, we still think that's okay. This has been a very debt averse industry, tech for quite some time. Now it's becoming a more capital intensive industry when historically it was capital light. And when you think about some of these other capital intensive industries, seeing higher levels of debt is kind of par for the course.
Right.
And we're not saying we get there, but I do think there's some runway for some of these companies to take on some level of debt, particularly given how healthy the balance sheets are and how low the debt levels are today. But I do want to continue to monitor the funding sources across kind of the AI landscape to make sure that they continue to stay high quality. Again, however, when we talk about some of the neo clouds, that's a different story compared to some of the hyperscalers that I was talking about, where there should be a higher level of discernment around the debt that's being taken up by those companies. And again, this is by no means any sort of recommendation, good or bad, on any of these companies. It's just an objective observation, if you will.
No, and look, I agree with you. And look, if I'm a company and I'm going to be investing in a data center, as an example, why wouldn't I use debt? because I'm buying real estate. I'm building a long life capacity.
100%.
And so why would I, and especially with debt levels where they are, I mean, if I'm borrowing money at 4.5%, and I'm going to get an 8 to 12 to 15% rate of return on that investment, why would I use cash? Why would I not use debt? And I think this is just part that I think this is something also that people overlook is just the time value of money and the use of leverage in the right manner.
Yeah, we've done some math too. Our fundamental equity team's done some math. When you look at kind of the returns at 0% leverage on, if you think of like compute, right, the chips, et cetera, and then when you think about the core and shell of your data centers, you almost double your potential return if you use at certain levels of leverage on the chips. And you can get a 50% higher return using leverage on the core and shell of the data center. So to your point, if you can use leverage and by the way, demand, right? So to pay back the debt, you need revenue and you need free cash flow, which means you need demand for your product. Demand has done nothing but accelerate for AI, for compute, for cloud services, for land. So I mean, if you heard Jensen Huang at the GTC this week, he mentioned that he sees $1 trillion revenue in NVIDIA's future. NVIDIA and a lot of these other semi companies already have their 2026, their entire supply accounted for. They're selling into 2027.
Yep.
And when you think about that token use, so as we continue to see demand be, I think, beyond robust. I think that's really, really supportive of the overall industry as we move forward. But again, I'm really, really mindful to continue to monitor the debt levels and who's taking out the debt as well.
Well, I can assure you right now that my chat is screaming about one issue in particular that we need to focus on, which is the circular financing, right? I talked to you about this a little bit at the conference, but there was a big concern about OpenAI, basically getting money from NVIDIA to buy the chips from NVIDIA, and the circular financing argument has gotten a lot of people concerned. It's like, oh, this is just a big bubble. It's all a scam. What's BlackRock's take on that?
Yeah. Again, I think the circular financing piece, it's important to understand context. And I think I shared this with the audience at the conference as well. This is not a new playbook by any stretch of the imagination. If you think about, again, we talk about capital intensive industries. If you look at kind of aerospace, Boeing Capital provides lending to customers to buy their planes, and then those customers put butts in seats and fly them around the world to produce revenue, and they pay Boeing back. John Deere has a financing arm. If anyone's ever bought a car from Toyota or Honda or Mercedes and you took out Toyota financing or Honda, you participated in circular funding.
Right.
You took a loan from a company to pay them money to buy their vehicle to pay them back. And again, a lot of this is, I think, underpinned or supported by the demand. And if demand continues to be robust, and at this point there's been no indications that demand is slowing down, then those companies continue to have the ability to generate the revenue, the free cash flow to pay that debt back. And the idea is that they're going to need, because this is now technology, AI is now a capital intensive industry, these companies will need funding sources to buy the compute, to buy the data centers to function. They're going to get it from somewhere. The way I think about it is some of these companies providing the funding or the financing or the equity investments, they're finding a shrewd use of their capital to help secure up their own balance sheets and ultimately keep some of these give these other companies the funding that they're going to need and that they're going to get from one source or another. So we again, I think this is worth monitoring, but the current state does not give us concern where we are today and directionally where we're heading, that this is a house of cards or anything of that nature.
So let me just kind of sum up our conversation today is that as an investor, and obviously, BlackRock has plenty of ETFs that kind of fill the investing environment that I'm looking forward to over the next 7 to 10 years, but focus a little bit on infrastructure now, still carry some weight in AI companies like Microsoft, Meta, Google, et cetera, the hyperscalers, because they're going to be the ones that are building these factories that will eventually participate them from. Expect future returns to start to grow as the consumer becomes the adopter, and then those adopters become robots and everything else once it reaches that enterprise phase. And so from a longer term perspective, the trajectory for revenue growth, and particularly given valuations where they are now, like NVIDIA trades at a PEG ratio of 1. And when you're looking at earnings growth rates, those are continuing to accelerate. The future looks pretty good for the AI front versus a lot of these headlines that we're currently seeing now.
I think that's right. And it's funny because when you talk about the headlines, right, for how long was the media blasting companies for buybacks and holding too much cash? Now they're blasting these companies for investing the capex in what could be the biggest economic revolution in years, right? So win or lose. And it's funny, you talk about like earnings. When earnings beats, everybody's like, see, this is the bubble we're talking about. When earnings miss, they're like, see, this is the bubble bursting. So I feel like regardless of what happens, we can't win. But I think you made a really strong statement in a summary of kind of where we are. Early in the adoption cycle, a lot of the revenue, a lot of the monetization, we're starting to see these companies integrate and monetize AI outside of tech as well. Logistics companies, healthcare companies, toy companies. So we're starting to see that kind of 5% of the future built companies, as Boston Consulting Group labels them, integrating and monetizing AI. So revenue, I think projections for the infrastructure, for the models, for the physical, a really, really, I think, robust future that we're headed into. And then the companies that can figure out how to monetize and integrate AI, I think have an opportunity to really build a competitive moat around their business and become industry leaders or separate themselves as industry leaders from some of the competitors. So I think it's a really, really interesting time that we're getting into. I think investing in the AI kind of revolution and then finding the best of the rest is going to be a really, really important way to think about, for a piece of the portfolio, allocating to something that can drive outperformance versus those traditional building blocks. Yeah.
And just to remind our listeners, so if you're interested in what we're talking about, Blackrock has 2 ETFs in particular, so Indigo David George Technology, right? So that's their infrastructure development ETF, and then Blackrock AI, BAI, are 2 ETFs that they produce that you can certainly take a look at the holdings of if you want to break it down and do individual stocks, or if you just want to track an index. Those 2 opportunities are there for you, and again, they do a great job in managing these vehicles as well.
And there's a handful of others. Those are the 2 that we highlighted. But I would just encourage folks to if you want to look at this more, you can go to iShares.com. We have a lot of different insights around the AI space. My team's thematic outlook includes this idea of compute and conflict, pipes and power. Compute being AI, conflict is the geopolitical fragmentation. Pipes is the infrastructure we talked about, which is connected to but also independent from AI. And then power, which is fairly self-explanatory. So there's a lot more that you can do to learn on iShares.com about the AI revolution, and the 2 tickers that we talked about, IDGT and BAI, as well as a few others that could potentially be appropriate for you and your investment goals to access the investment opportunity across the AI value chain.
But be sure and talk to your advisor first before
100%.
Do your research and talk to your advisor to make sure these are appropriate for you and your goals. So last question, Brian, I think probably the most important: how long before AI puts us out of a job?
That's a remarkable question. I think that you and I are both far too talented and far too handsome to lose jobs.
Great answer. We'll end it right there.
Yeah, we can leave it at that.
Brian, thank you so much for your time today. Brian Dunlap, he is with Blackrock, and I'm going to have him back also. He's also covers crypto, the crypto space as well. Obviously, crypto's been under a lot of pressure as of late, and again, a lot of questions about, is crypto dead now? And so I'm certainly going to have Brian back to talk about crypto next time. But again, if you like this interview, be sure and like and subscribe to our channel. Also, go by our website. If you have any questions, send those to me. Realinvestmentadvice.com is the website. And we appreciate you being here. We'll see you for the next live interview edition of the Real Investment Show next time. Have a great day.